Ever thought, I don't want an education loan? They charge way too much interest. Education loans do seem costly, but what if they tell you that it doesn't have to be that way? I can help you calculate interest rates, the policies they follow, and how to negotiate a better deal. With this knowledge, you can turn the tables in your favor without burning many calories. Before we start learning about complexities related to interest rates, we should know something about education loan. So whenever we are talking about the money, it all comes to the Reserve Bank of India. It created a model of education loan schemes and set basic terms and conditions that lenders follow while giving out loans to students. And guess what? The RBI charges a repo rate to lend money to the banks. Naturally, banks add their own margin to it. This combined rate is your interest rate. For example, UBI charges around 2% over the current repo rate. Since the current repo rate is 6.50%, this means education loan interest rate is 2% plus 6.50%, which comes to 8.5%. However, apart from the repo rate, there are many other factors that affect the interest rate on your education loan. Your university's rank plays a big role in deciding your interest rate. Every lender has their own list of approved universities divided into categories such as top universities, good universities, and average ones. And these categories directly impact your interest rate. For example, SBI recently launched a product offering unsecured loans for students going to the top 100 universities. This makes loans way more affordable as long as your university is on the list. But if your university isn't included, or if public and private banks aren't an option, there's still hope. And that is where NBFCs come to the rescue. They offer semi-collateral loans with student-friendly repayment options, making them a great alternative. The next factor is the most important and sensitive part of education loans, the repayment plan. To understand your repayment plans, it's super important to understand all the factors that affect your repayment plan. First is the moratorium period. This is the relief or the grace period where you're not obligated to make full payments while you're studying. Most lenders offer the moratorium period covering your course during plus 6 months. For the repayment, many lenders provide a full moratorium, meaning no payments at all during this time. Others provide a partial simple interest option where you pay a small fixed amount, say 2,000 rupees to 5,000 rupees per month during your course. But all lenders don't offer this benefit. Many lenders ask for the full interest payments or even full EMIs during the moratorium. So before committing, do the math. Calculate how much you and your co-applicant can afford to pay per month and choose the right repayment option. The next question that students often ask is, what if your salary is not enough to cover the fixed EMI? You have income-driven repayment, also known as IDR, which can help you adjust your EMI based on the monthly income, making repayment much more manageable. This option can truly be a lifesaver, so you ask your lender about it and get your EMI adjusted. Now you know all the factors that affect your repayment plans, and those are the repo rate, your course and university, your repayment plan, and your co-applicant's income. But now you are stuck between lenders? Click the link in the description box to check your loan eligibility. Just fill in a few details and you'll instantly see how much you can borrow, plus a list of lenders offering loans. You'll also get a free education loan counselor to guide you through the entire process with no hidden charges and no hassle. Alright, I hope you learned something new today. If you did, do me a favor, hit that like button, share this video with your friends, and do not forget to subscribe for more tips on study abroad journey. Until next time, take care and goodbye.